Imagine this. You've just sold your vintage car, or perhaps you've saved up a mountain of cash from side gigs and birthday gifts over the last 5 years. You have exactly $11,000 sitting in a shoebox under your bed. You walk into your local bank branch feeling like a success. But as you approach the teller, a thought crosses your mind. If I deposit all of this at once, the government is going to flag me. They'll ask questions. They might even try to tax this money twice. So you decide to be smart. You take $5,500 out of the envelope and hand it to the teller. You plan to come back on Thursday to deposit the rest. You think you're protecting your privacy. You think you're avoiding a headache. In reality, you have just committed a federal felony. At that exact moment, the teller isn't smiling because they're happy for your success. They are quietly triggering a silent alarm. They aren't allowed to tell you they're doing it. There are no sirens, no handcuffs, not yet. But behind the scenes, a digital file has been sent directly to the Department of the Treasury. By trying to avoid a simple, routine piece of paperwork, you have just walked directly into a trap that the IRS and the Department of Justice use to seize billions of dollars from ordinary Americans every single year. This is the $10,000 rule that nobody explains to you until it's too late. And what you don't know right now could cost you every cent you've ever saved. What you are caught in is a web designed to catch drug lords and terrorists, but it's currently being used to ensnare grandmothers, small business owners, and everyday savers. This isn't just about taxes, it's about a concept called structuring, and it is the most dangerous financial trap in the United States legal system. The system is designed so that your very instinct for privacy is used as evidence of a crime. The core of this issue is the Bank Secrecy Act of 1970. On the surface, the rule sounds simple. Any cash transaction over $10,000 requires the bank to file a Currency Transaction Report, or CTR. This report goes to FinCEN, the Financial Crimes Enforcement Network. Most people hear $10,000 and think, okay, as long as I stay under that, I'm invisible. That is the single most expensive lie you will ever believe. The authorities do not want you to know that there is a second, much more shadow-like report called the SAR, the Suspicious Activity Report. While a CTR is mandatory for amounts over $10,000, a SAR is filed whenever a bank employee feels like you are trying to circumvent the $10,000 limit. If you deposit $9,500, they file a SAR. If you deposit $5,000 today and $5,000 tomorrow, they file a SAR. Here is the insider secret that banks are legally forbidden from telling you. Under federal law, specifically 31 U.S. Code Section 5324, it is a crime to structure transactions to avoid the reporting requirement. The terrifying part? It doesn't matter if the money came from a completely legal source. It doesn't matter if you already paid taxes on it. The act of splitting the money to avoid the report is, in itself, the crime. You are being punished for your intent to maintain privacy. I have seen lives ruined because people thought they were being, quote, discreet. The government has the power of, quote, Civil Asset Forfeiture, which means they can seize your bank account first and ask questions later. You then have to spend years and tens of thousands of dollars in legal fees to prove you're innocent to get your own money back. The industry doesn't explain this because the bank's primary loyalty isn't to you, it's to the federal regulators who will fine the bank millions if they don't snitch on you. You are walking through a minefield, and the only way to get to the other side is to stop trying to hide and start understanding how to document. Let's look at how this plays out in the real world so you can see the tripwires before you step on them. Scenario 1. The private seller. Imagine you sell a piece of heavy equipment or a used boat for $12,000 in cash. You're a private person and you don't like the idea of the government tracking your every move. The mistake. You go to the bank and deposit $6,000 on Monday. You wait until Friday and deposit the other $6,000 at a different branch of the same bank, thinking you've bypassed the system. The consequence. The bank's software automatically links these deposits because they are attached to the same Social Security number. They flag it as structuring. Now, instead of a routine report being filed, you are under investigation for a felony. The solution: you must deposit the full $12,000 at once. When the teller says, "I have to fill out a form for this," you should respond with, "Absolutely, I have the bill of sale right here for your records." Do not act nervous. Do not ask, "How can I avoid the report?" Simply provide the documentation that proves where the money came from. If you have a bill of sale, the CTR becomes a harmless piece of paper that will likely never be looked at again. The report is not the enemy. The avoidance of the report is. Scenario 2, the small business daily grind. You run a small coffee shop or a landscaping business. On a good weekend, you might take in $11,000 in cash. The mistake: you're worried that depositing more than $10,000 will trigger an audit, so you purposely keep your deposits at $9,900 or $9,000 every single Monday. The consequence: this is a massive red flag for the IRS. A pattern of deposits just under the threshold is the textbook definition of structuring. It's actually more likely to trigger an audit than a $15,000 deposit would. The solution: you should ask your bank about exempt person status. Under certain conditions, high-volume cash businesses can be exempted from routine CTR filings if they meet specific criteria. But regardless, your script to the bank should be, "My business is seeing an increase in cash volume. I want to make sure my accounts are fully compliant with FinCEN regulations. What documentation do you prefer I provide for my weekly deposits to ensure everything is transparent?" By being the one to bring it up, you move from suspicious to compliant in the eyes of the bank's risk department. Scenario 3, the generous relative. Your grandmother passes away and leaves you $20,000 in cash she kept in a safe. She wanted you to have it for a house down payment. The mistake: you're afraid the IRS will take 40% in inheritance tax, so you decide to deposit $2,000 every month for 10 months. The consequence: this is long-term structuring. Eventually, the bank's algorithm will catch the pattern. They will freeze the account. And because the money came from a deceased relative with no quote-unquote paper trail, the government may argue the money is from an illegal source. You need to document the source before you touch the bank. Get a copy of the will or a signed affidavit from the executor of the estate. When you go to the bank, say this: "I am depositing $20,000, which was a cash gift/inheritance from a family estate. I have the legal documentation from the estate executor right here. Please file the necessary CTR so we are in full compliance." Most inheritance or gift cash isn't even taxable under certain thresholds, so you're often hiding from a tax that doesn't even exist while committing a crime that definitely does. Scenario 4, the privacy advocate traveler. You like to keep cash for emergencies. You decide to take $15,000 in cash on a domestic flight to buy a car in another state. You split the money between your carry-on, your pocket, and your spouse's bag to avoid having too much in one place. If TSA or airport police find this, they don't even need to prove a crime. Under Civil Asset Forfeiture, they can seize the cash on the suspicion that it's related to drug trafficking. The fact that you hid it in different bags is used as evidence of guilt. While there is no legal limit on how much cash you can carry domestically, carrying large amounts is high risk. If you must do it, keep it in one place with the bill of sale or bank withdrawal receipt physically attached to the money. If questioned, your script is, "This is $15,000 of legally obtained currency intended for a specific purchase. Here is the bank receipt from the withdrawal and the contact info for the seller. I am not violating any currency laws." Never hide the money. Hiding is the hallmark of the guilty in the eyes of the law. Scenario 5, the crypto to cash bridge. You've made a killing in Bitcoin, and you use a P2P exchange to sell for cash. You meet someone, they give you $12,000 in physical bills. The mistake: you think the IRS can't track crypto, so you deposit the cash in small increments of $2,500 over several weeks at different ATMs. The consequence: ATM deposits are monitored even more strictly than teller deposits. Multiple cash deposits at an ATM is a Tier 1 SAR trigger. You will likely have your entire bank account closed without explanation. The solution: Keep the transaction logs from your exchange. When you deposit the cash, walk into the lobby. Tell the teller, I have sold a digital asset and I'm depositing the cash proceeds. I have the trade confirmation here. Yes, you might have to pay capital gains tax, but that is significantly cheaper than losing 100% of the money to government seizure and facing a 5-year prison sentence for structuring. Now, I want to give you what I call the 5-minute shield. This is the ultimate defense you can set up today to ensure you never fall victim to these aggressive laws. Most people lose their money because they can't prove their intent. If you can prove you weren't trying to hide the money, the structuring charge usually falls apart. Here is your 3-step checklist to execute today. Step 1, create a Cash Origins digital folder. On your phone or computer, create a folder. Anytime you receive more than $500 in cash, whether it's a gift, a sale, or a withdrawal, take a photo of the receipt, the bill of sale, or even a handwritten note signed by the person who gave it to you. Step 2, the consistency habit. If you are going to deposit cash, pick a specific day of the month and deposit whatever you have, regardless of the amount. Never, ever look at the total and say, that's too close to $10,000, let me take some out. If it's $11,000, deposit $11,000. If it's $9,000, deposit $9,000. The lack of an evasive pattern is your greatest legal protection. Step 3, the banker relationship audit. Go to your bank and ask to speak with a personal banker. Simply ask them, what is your bank's policy for documenting large cash deposits for long-time customers? They will likely tell you about CTRs. Your response should be, great, I want to make sure I'm always providing the right paperwork so your compliance team is happy. When you are on record asking how to be more transparent, it becomes almost impossible for them to argue in court that you had the intent to be deceptive. This information is not just financial advice. It is a survival guide for the modern era. The IRS and the government rely on the fact that you are scared of paperwork. They bank on the fact that you will try to take shortcuts to protect your privacy. But in the world of federal banking laws, a shortcut is a direct path to a jail cell. I'm not asking you to like this video. I'm not asking you to subscribe for more content. I am asking you to take the link to this video and send it to one person you care about. Send it to your parents who might be sitting on a cash nest egg. Send it to your friend who just started a small side hustle. Send it to the person you know who is selling their car this weekend. One simple text message from you could be the difference between your friend keeping their life savings or having it wiped out by a government seizure they didn't see coming. We have to look out for each other because the system is no longer designed to look out for us. It is designed to look for red flags. And unfortunately, innocent privacy looks exactly like a red flag to an algorithm. Before you go, I want to hear from you in the comments. Have you ever had a bank hold your funds or ask you too many questions about a deposit? Have you ever been afraid to deposit your own hard-earned cash because of these rules? Share your story below. Your experience could be the final warning someone else needs to hear to avoid a life-changing mistake. Let's start a conversation that the banks would rather we didn't have. Stay safe, stay documented, and I'll see you in the next one.